Excited to have our Blockchain Security 101 workshop today. So I'm Christian. I'm the researcher in residence at Forta. I just recently joined Forta about 3 weeks ago. Before that, I was a security researcher at Microsoft, working on the Microsoft Defender suite. And over the last year, I have learned a ton about the blockchain and the blockchain security space. And so I've put together a slide deck that shares what I've learned over the last year. And I hope you find it useful. Let's see here. Okay, so let's jump in. So what we'll do in this presentation is really give you a 101 introduction about blockchain concepts, explaining the blockchain, mining, wallets, and smart contracts. Then we'll go into common security issues, looking at it from a perspective of the end user, as well as dApps and smart contract developers. And then close out with a few security practices. This presentation is set up to have essentially no prerequisite, so you find that it provides you all the necessary background to follow along. So first off, why do we talk about blockchain security? Well, the market cap of cryptocurrency stands at $1.8 trillion today. And there is about $212 billion that are actively locked into kind of blockchain protocols that are essentially at risk of getting hacked and lost. Here you'll see a couple of examples from our website, as well as rec.news, that give you a sense of kind of the volume and the magnitude of hacks that have happened over the last year, and every week there is a massive amount of hacks happening with large amounts of funds getting lost. So now blockchain, there's some illicit usages of blockchain. So the Treasury, Janet Yellen talked about, hey, cryptocurrency is used for money laundering and used for kind of online drug traffickers. And while this is the case to a certain extent, if you look at the chain analysis report, it is really a tiny fraction of all the transactions that are happening on the blockchain. So I think Janet Yellen's narrative is not quite reflecting reality. And a lot of the participants in the blockchain space have kind of volunteered already to put anti-money laundering, as well as know your customer regulations kind of in place on a voluntary basis. If you come from a traditional security background, you're probably well aware that cryptocurrency is used in that space as well. Ransomware is a prime example. I think ransomware couldn't really exist without the blockchain. Ransomware usually asks for the ransom to be paid in cryptocurrencies. And then also we see some threat actors that utilize kind of the resilient infrastructure that blockchain provides to kind of set up their illicit infrastructure. And unstoppable domains would be an example of that, where somebody can set up a domain that is not possible to take down, for instance. Now, what is a blockchain? So a blockchain is a distributed, secure, immutable ledger where participants are inherently not trusted. And so on the first table here, you kind of see what a ledger looks like. It's essentially a set of transactions. So think of, John has 1 Bitcoin, and John decides to give me 0.1 Bitcoin. So that is a transaction that is recorded on the blockchain. And then if you look at the history of all the transactions that happen on the blockchain, then you're able to essentially derive the balance of a cryptocurrency for each individual account. Now, a blockchain is called a blockchain because these sort of transactions are organized into blocks that you see on the slide here. Every block has essentially a reference to the previous block through a cryptographic hash, and then kind of blocks are getting added to the blockchain, hence it's called a blockchain. It is distributed in that there is a large number of nodes that essentially have a copy of the blockchain. Now you may ask, well, how is a block created? So the block is created by special nodes that are referred to as miners. And a miner earns the right to add a block by solving a cryptographic puzzle. And that cryptographic puzzle is essentially calculating a specific cryptographic hash of the previous block hash plus a random string that the miner provides. And if that hash starts with X number of zeros, then they essentially solve the cryptographic puzzle. Finding that nonce, that essentially that random piece of information that is included in the function to calculate the hash is extremely difficult. And so a miner has to, try millions, billions of times to calculate that hash to find one that is considered a solution. So the example that I have on this slide, right, we have let's assume block 2 exists. That has a hash of ABC. The miner creates a nonce, so this random string 1A2, concatenates these two, calculates the SHA-256, which is the cryptographic hash algorithm, and that produces now a value that starts with 5 zeros. And so if there's 5 zeros in that hash, and the number of zeros is kind of determined by the difficulty of the network, then they solved that puzzle and earned the right to add a block to the blockchain. And for that work, they get rewarded, in Bitcoin's case, approximately 6 Bitcoins. Now, what are smart contracts? So smart contracts, so the Bitcoin blockchain is really about mostly around transfer of value. Ethereum is another blockchain that introduced the concept of smart contracts that are executed on the Ethereum virtual machine. And a smart contract is essentially a deterministic piece of code that is executed by the miner during block creation. Smart contracts can hold and operate on digital assets and even create new digital assets. And this is really a big step of innovation in this space, because it really opens up many, many use cases that were previously not possible. And let me give you a couple of examples so you get kind of a sense of what smart contracts are able to do. So let's assume you have a new digital asset and you want to essentially sell that. And so you may have a smart contract that's an initial coin offering smart contract that acts in the following way. If it receives 1 Ether, which is the native currency of Ethereum, then it will give you 100 link tokens, which is another digital asset in return. Now, one thing that these smart contracts are able to do, they're also referred to as kind of Lego pieces on the blockchain. They can be chained together. So let's assume you have wrapped Bitcoin and you want to convert that into Link. Well, maybe there is no smart contract that does that conversion, but there is a smart contract that allows you to transfer, like exchange wrapped Bitcoin into Ethereum. And then there's another smart contract that allows you to convert Ethereum into Link. And so you can kind of chain those smart contracts together to accomplish the goal that I just described. The other thing that smart contracts are able to do is maintain state. And the example on the right here kind of illustrates how that works. So you may have a smart contract that's an interest-bearing smart contract, where I can deposit some funds into, then it will generate some interest, and I come back later to that same smart contract and withdraw my funds. So I deposit 1 ETH, maybe a year later, I go to the same smart contract and withdraw my balance, and now I earn 10% of ETH. And so smart contracts, as I mentioned, really opened up use cases on the blockchain. There is a large use case around decentralized finance. So think of all the kind of services that traditional banks and investment institutions provide are getting built on the blockchain. So that means remittances, exchanges, derivatives, passive income, options trading, payment. And the really neat thing about the blockchain is, well, there is no more a centralized entity that you have to trust, but rather that trust is encoded in the smart contracts itself. So it's a trustless setup. And then on the right here, you also see some innovation that is happening kind of in the NFT space that you may have heard about, metaverse, gaming, arts, collectibles. And it's starting to kind of move into kind of non-media type of value, where you have kind of access and identity, as well as kind of tokenization of real world assets. And so, I mean, I think we're generally still at the start here. If you think about kind of the .com era in the 90s, I don't think anybody was able to predict a service like Uber. And I very much expect that similarly in the blockchain space, there is a whole bunch of innovations that will come out of the space that we're just not able to envision yet. And so it's a really exciting space. Now let's start to talk a little bit about some of the attack scenarios. So you may have heard about this concept of a 51% attack. So let me explain how that works. So as I mentioned, a miner essentially solves that cryptographic puzzle to earn the right to add a block to the blockchain. So if you look all the way on the left, there's one block, and nothing precludes a miner, or even it could happen by coincidence, that two miners solve the cryptographic puzzle at the same time. And so then you essentially kind of have a split of the blockchain. So how do you decide which one is the valid blockchain? And the way that gets decided is the longest blockchain is the valid one. So the top one is the valid one. The one with kind of the one node all the way to the left is essentially a blockchain that gets abandoned. Now, in a 51% attack, what that means is the majority of the miners are controlled by one entity and behave maliciously. And what that allows that set of miners to do is essentially produce a blockchain that is longer than the legitimate blockchain. And so what that could lead to is essentially double spins, because you essentially have a shorter legitimate one and a longer malicious blockchain. And so if you go into a store and buy a coffee with your cryptocurrency, the merchant will receive that cryptocurrency, but then on the second chain, that same cryptocurrency could be spent again. The other thing that a miner is able to do is deny transactions to be included, because a miner, when they create a block on the blockchain, essentially look at a queue of transactions to choose from to include into the block. And so if you control 50% of the hashing power, they could basically just choose not to include your transactions. Now, one thing that a 51% attack does not do, it does not change the protocol rules. So one could not reverse transactions, one could not insert fake and unsigned transactions, create new assets, alter functionality of block rewards. So I think a 51% attack is often kind of viewed as this really scary thing where the blockchain breaks. That is really not the case. And the more hashing power, so the more miners are involved in the creation of the block, the harder the 51% attack becomes. And so the more hashing power, the more miners, the more secure a blockchain really is. Now, talking about wallets. So wallets, conceptually hold your cryptocurrency. But that is really not the case either. Wallets do not hold a cryptocurrency, but rather the private keys that allow to transact on the digital assets that are associated with your private key. So the private key is really it's the key to your digital assets. And there's two types of wallets. There is a custodial wallet that is essentially associated with centralized exchanges like Binance and Coinbase. And basically they hold and manage the private key for you. And on the other side, you have non-custodial wallets like MetaMask or Zengo that hold the private key. You essentially control the private key. And so with kind of these two models, the risk profile of your private key is very different. On the custodial wallet, you essentially entrust the exchange to secure your key. And on the non-custodial side, you're really responsible to manage the security of the key. And if you have a non-custodial wallet, there is a whole slew of threats that you're exposed to. One of those threats is malware. So if you have a non-custodial wallet installed on your machine, the private key is stored somewhere on that machine, and malware can essentially search your machine and try to extract that private key. Once the attacker has the private key, they're able to essentially steal your funds. And there's a variety of tricks that malware utilize. They may be, the key may be encrypted on disk, but potentially it gets temporarily loaded into memory in a non-encrypted fashion. And malware can continuously scan the memory to steal that key from there. They can also kind of search your disk. So if you store your private key in a text file, they will search your disk and find it. They look through log files. They look through browser cache. Another thing that they're able to do is monitor the clipboard. Here, they're not necessarily stealing the private key, but they may trick you into signing a transaction that transfers funds to the attacker. So let's assume I want to transfer a fund to Dani. He will send me his public address, maybe an email. I copy and paste that into my wallet address. And so there's malware that kind of listens for these clipboard events and exchange essentially the address. And then I essentially accidentally will sign a transaction to send funds to the attacker if I'm not careful. Hardware wallets are non-custodial wallets where the private key is stored in a secure enclave. So Trezor and Ledger are a couple of large hardware wallet providers. That is certainly much more secure than a software wallet or many of the software wallets. But there's also some risk exposure there in terms of side channel attacks that may allow an attacker to obtain the key from there. Now, one thing that is happening in this space is also a ton of scams. And one of those scams is ice fishing. And so let me explain how ice fishing works. And as I kind of walk through these attacks, I will give you the necessary background to really understand how it works under the covers. And so this slide is really mostly background information. So on Ethereum, there is a concept of ERC20 tokens. So these are kind of new digital assets that you can create on the Ethereum blockchain. And the way that is implemented is through essentially a smart contract. And the smart contract contains a mapping of addresses to the balance of those tokens. So in this example here, we have the USDC coin, and account 1 has 500, account 2 has 10,000, account 3 has 100 of these coins. The smart contract then also provides functions that allow you to transfer the assets that you have to another account. So there is a transfer function where I could say, hey, transfer my 500 from account 1 that I own to account 2. And then it would essentially update the balance in that balances mapping data structure. Now, if I were to want to trade my USDC ERC20 token for another token, I can go to a decentralized exchange like Uniswap that allows me to do that. Now, in order for tokens to be swapped, I first need to grant the Uniswap decentralized exchange rights to operate on my tokens. And I do that by first signing an approval transaction that basically says, Uniswap, I want to trade my USDC to, let's say, Link tokens. And then Uniswap says, okay, but first, I need to have the right to withdraw USDC from your USDC balance. And so there's essentially two transactions that I need to sign. First, that approval, and then second, the transfer. And then what happens is Uniswap will basically take the USDC out of my balance, transfer it to their pool, essentially, and then they will deposit Link for my account. Now, how can that be abused? Actually, before we go into that, this screenshot kind of shows how that visually looks like. So this is a screenshot of the Uniswap DEX, where I exchange 1 USDC to 0.049 Link. As you see in the red here, it basically says, hey, allow Uniswap protocol to use your USDC. You click on that, and then you essentially get that approval transaction pop up in your non-custodial wallet like MetaMask that basically signs that transaction. Now, if you look at that transaction, it is very cryptic. It has a whole bunch of hashes and some values, and it is, in my opinion, hard to understand. And so what attackers do in an ice phishing attack, and there was an ice phishing attack back in December, is they take advantage of the fact that this is not easily understood. And in the Badger DAO attack, $120 million were lost. And what happened was the attacker essentially compromised the front end, so the web page of the Badger DAO, DApp, that then essentially produces transactions to interact with the smart contract. And when you were interacting with the web page, it would prompt you to sign an approval transaction that would not grant the Badger DAO access to your funds, but rather grant the attacker access to your funds. And that was happening over a few weeks, where essentially the attacker accumulated a whole bunch of approvals. And again, keep in mind what that does. It really grants the attacker permission to withdraw funds from your account. And then in early December, that's exactly what the attacker did. And $120 million were lost as a result. So that's ice phishing. The other scam that we often observe are rug pulls. And so these are essentially scams where the developers of the project run away with the users / investors' funds. And there's two types of rug pulls. There's hard rug pulls, where the developers have a malicious intent from the get-go, where they essentially set up their smart contract, their token, in a way that you could purchase it, but you couldn't sell it. So that would be an example of a hard rug pull. Soft rug pull is more of a classic pump and dump, where a token gets created, it gets advertised, the price goes up, but developers still hold a ton of the tokens. And once the price is up, they sell everything. And then, of course, the price crashes and all the investors are left holding the bag. Next, let me talk about maximal extracted value, or MEV. So MEV is a technique where you're able to insert transactions or create transactions that extract value from unsuspected users. And so let me explain how that works. So let's assume I want to buy a ton of Bitcoin. I will sign a transaction saying, hey, I'm buying a bunch of Bitcoin. And that will temporarily sit in this pool of transactions that the miner, once they solve that cryptographic puzzle, will pull transactions from. So those transactions are essentially in that pool and publicly visible. Now, what a malicious actor can do is they can monitor that pool and see, hey, Christian is looking to buy a bunch of Bitcoin. And the attacker can now insert a transaction that is kind of higher priority to buy Bitcoin before me. As a result, the price of Bitcoin will go up. Then my transaction gets executed. So I will pay a little bit more Bitcoin, a little bit more per Bitcoin. Price continues to go up. And then the attacker, who essentially bought the Bitcoin for cheap, will sell their Bitcoin after my transaction. And so I kind of get sandwiched, essentially, by the attacker around my transaction. And I essentially get a worse deal that I would have gotten if the attacker wouldn't have been involved. So in a way, it's kind of stealing some funds from me. The other thing is, when you execute a smart contract may rely on properties of the mined block to change its behavior. One thing to keep in mind, smart contracts are deterministic. There's not true randomness. But you have to keep in mind that the block properties are controlled by the miner that creates the block. So let me give you a particular example here. So let's assume there's a gambling smart contract that will create a payout once you roll the dice and it lands on number 6. Now, the logic of the smart contract could say, I don't have true randomness. I will take a look at the block, seed my random number generator with the number of transactions, and based on that, we'll generate the roll of the dice. Well, again, that is something that is controlled by the miner. And so a miner could theoretically insert the number of transactions as well as a transaction with the gambling contract to make themselves the winner. So that's just something to keep in mind, that there is no true randomness, and if smart contracts rely on block properties to kind of generate something pseudo-random, that's something that the miner is able to control and extract value of. Then there's a whole slew of smart contract exploits that exist. So here we have an example of an arithmetic over and underflow. The smart contract that you see here is essentially a time lock, where, hey, I deposit some funds into the smart contract. It gets locked for a week before I can withdraw it. But there is an overflow here that essentially allows the somebody to reset the time lock, essentially breaking the intended smart contract functionality. And so there's a whole slew of security issues that any smart contract developer should be aware of. What I would point folks to is Mastering Ethereum is a great introductory book, as well as Open Zeppelin's Ethernaut, which is kind of a capture the flag site that is really excellent to get more familiar with these security issues. Reentrancy is a special type of a security issue where the smart contract developer has not considered that a transaction or could invoke other codes. So let me give you an example here. So let's assume you have a smart contract that allows you to deposit ETH and then withdraw ETH at a later point in time. And so the top here kind of shows that flow. If it's an account that or an externally owned account that has no code associated with it, it's totally fine. But now let's assume that account that deposit the funds is actually a smart contract. And so what happens here is the smart contract, the malicious smart contract, deposits an ETH. Later on, it invokes the withdraw function. But now, upon receipt of that ETH, the malicious smart contract can run code again, and it will essentially continue to withdraw ETH because the vulnerability in the smart contract was such that the balance was not updated. So I deposited one ETH. Upon withdrawal, it will send the ETH and then update the balance. What should have really happened is first the balance update and then the ETH gets withdrawn. And so essentially you can recursively, continuously call the withdrawal function on the vulnerable smart contract to drain additional funds that really don't belong to you. And here's a code example of that. We'll share the slides at a later point in time that allows you to kind of look at how that works in detail. Next attack that I want to go through is a flash loan. And this is a really interesting attack, also commonly referred to as an economic attack. So a flash loan essentially allows somebody to obtain a large amount of digital assets for a small fee without collateralization. This really works because the flash loan must be paid in the same transaction. Transactions are essentially all or none. So if parts of the transactions fail, the entire kind of set of transactions fail. So if I withdraw funds but don't pay them back, then all kind of the previous steps will fail as well. And the reason that these flash loans exist is there's a legitimate reasons for those. It's primarily around arbitrage, where somebody is able to use flash loans to even out price inefficiencies in the market. So let's assume I have two exchanges and the price of Link is high on one exchange and low on the other exchange. A flash loan allows me to essentially create the funds to buy the Link for cheap and sell it for more expensive. And what that action does by the arbitrageurs, they will get, of course, a profit, but it will really even out the price of Link across all exchanges. And so they really fulfill an important role in the DeFi ecosystem. Now, a flash loan attack uses the funds obtained by a flash loan to manipulate the price of a token to drain funds from a smart contract. So before I go into the attack, let me first explain to you automated market makers. So automated market makers are special smart contracts that facilitate exchange of funds. And the way to best understand this is by one of my personal experiences. I traveled from China to Vietnam a couple of years ago, and I wanted to exchange essentially the Vietnamese dong into Chinese renminbi, but there was no bank that essentially allowed me to make that exchange. And so we talked to people, and eventually we found a helpful person in China that took our Vietnamese dong and raised it in the air and said, "Does anybody want to buy this?" And fortunately, there was a Chinese citizen that says, "Yes, perfect. I want to buy this." I probably did not get the best exchange rate as a result of that. What really should happen is a bank should hold both assets, and there's going to be an exchange rate associated with it. I can go to the bank and essentially exchange those funds. And that's exactly what automated market makers do. And the way to think of an automated market maker is they hold essentially the two assets that would be exchanged, and the ratio of the assets in the pool determine the price. So in the example here, I have an ETH USDC pool. If 100 ETHs are contained in the pool and 1,000 USDC, then essentially one ETH costs 10 USDC. If there's 200 ETH and 2,000 USDC, the price doesn't change because the ratio doesn't change. But if the ratio starts changing, so let's say 100 ETH and 3,000 USDC, suddenly ETH is much more expensive, 30 USDC. So in a way, the AMMs allow you to determine the price of an asset. And certain smart contracts utilize those AMMs for price information. Now, what a flash loan attack allows you to do is borrow large amounts of funds. So in the example here, we have an attacker that borrows 100,000 ETH, 1 million USDC. They then swap 100,000 ETH for 2 million USDC. And what that does, it drives the price of ETH down. Then they take their funds and go to, let's say, a vulnerable collateralized loan contract to borrow ETH against USDC. Now, what happens is that particular vulnerable collateralized loan contract will turn to the AMM to get price information. But keep in mind that the attacker just manipulated the price. So they have incorrect price information. And so what that allows the attacker to do is to borrow more funds than they otherwise would have. And they make a profit. And then they return the original funds that they loaned from the flash loan lender back to that contract, and they essentially get to keep a profit. In this particular example, 50 ETH. So that's how flash loan attacks work. So hopefully that kind of gives you an overview of the security issues that exist in Web3, both on the end user side as well as kind of the dApps and the smart contract development side. As an end user, there's a slew of best practices that I would recommend. First of all, use a hardware wallet or a secure multi-party computation wallet. So that's a software wallet that manages the private key more securely than traditional software wallets. Zengo is an example of that. Don't chase the 1,000% APY. If the return sounds too good to be true, it is probably a scam. Disconnects from sites and revoke token access. The ice fishing attack is a great example here, where as you interact with smart contracts, even legitimate ones, right, you are granting them to operate on your funds. If that smart contract gets exploited, potentially that could allow them to withdraw your funds. So if you exchange a token, you allow that smart contract to act on your tokens. After the exchange, revoke token access. Run an endpoint with phish protection, anti-malware protection. As I explained, there is malware that is after your private keys. That significantly reduces the risk. Some people even choose to operate on a different device for all their security, for their crypto transactions. Use two-factor authentication on all accounts. Never share your seed phrase or a private key. That is the key to your digital assets. Nobody ever asks for these in a legitimate fashion. Don't store that information in the clear. You may not share it actively, but if you have malware on your machine, it may obtain that information. Use multiple accounts as you interact with the ecosystem. And then lastly, you can also buy insurance, such that if, let's say, there's a smart contract that gets exploited and your funds are getting lost, that could be an avenue to recover your funds. Now, if we're thinking about dApps and smart contract development, that obviously is a lot of responsibility. Some of the protocols have, hundreds of millions of dollars locked inside that protocol. And so here you really need to take a comprehensive security approach, a layered security approach. There is no silver bullet in the security space. You cannot rely on one thing and trust that will protect you. So there are a common set of practices that are being utilized in kind of the pre-deployment stage. One is utilization of template contracts. So these are audited, heavily reviewed libraries that provide rich functionality that you can use. Don't reinvent the wheel. Utilize one of those smart contract libraries, and OpenZeppelin has a rich set of libraries available. Smart contract audits. That is certainly a must-have. So this is where a smart contract auditor reviews the smart contract code in detail and flags any security issues that you then able to fix before that smart contract gets deployed. Smart contracts certainly a must-have, but you cannot rely on smart contracts alone. Penetration testing, very common in the Web 2 space, also applied in the Web 3 space. And then lastly, documentation in the pre-deployment step. Document your security measures that you have put in place. If you have difficulty documenting it, maybe there's room for improvement. So those are kind of the steps on the pre-deployment side. But you also have to think about post-deployment. So now your smart contract is out there. How do you secure it at that point in time? Bug bounties are common in the industry, where essentially you incentivize security researchers to essentially penetration test your protocol, review the codes after it has been deployed, and then report that in a responsible manner for a bounty. Real-time monitoring and alerting is also a must-have. Again, think of the scenario where maybe a bug was missed, and now your smart contract gets attacked and exploited. This is really where Forta comes in. It's a distributed real-time monitoring solution to surface security issues, attacks that really put smart contract developers and dApps and protocols in a position to react to security incidents and potentially mitigate an attack and secure funds. So monitoring and incident response really goes hand in hand. So again, you really need to take a layered security approach in the space. One thing will not secure your protocol, and you have to keep in mind that with hundreds of millions of dollars potentially locked in these smart contracts, that makes it a very attractive target for attackers that are financially motivated. And so that was my last slide. I hope you found the presentation informative. We have another workshop coming up in a couple of weeks where we'll dive into an attack in more detail and showcase how you can develop a detection bot on the Forta platform, on the Forta network, that would allow you to identify that attack. So that is coming up on Thursday, the May 19th at the same time. So thank you all for listening. Juan, I'm not sure whether there's any questions. So how can we prevent, detect these MEV attacks? So the mechanism that I described is where attackers are able to monitor transactions that sit in that temporary pool called the mempool, and then they kind of insert transactions around your transactions. There is, on Ethereum, there's a project called Flashbots that allow you to submit a transactions directly to the miner, bypassing the mempool. That certainly reduces the risk, but you also now entrust that the miner is not taking advantage of you. But it certainly is a step that you can take to reduce the risk of some of these MEV attacks. Any other questions? Well, thanks so much again for joining, and hope to see you in a couple of weeks.